The information and opinions expressed in this video are of a general nature and are not intended to be investment advice, research, or recommendations. Please consult your investment professional for your own circumstances. The information in this video reflects the opinions of Arca Labs and the video's participants on the date of production and are subject to change at any time without notice due to various factors. Arca Labs is separate and unaffiliated from any third parties participating in the video presentation, and Arca Labs is not responsible for any third parties' products, services, or policies. Welcome to Tokenization Talks, powered by Arca Labs. I'm Annelise Osborne with Arca Labs. We are focused on innovating responsibly. We are excited to bring you institutional thought leaders in the digital asset space. Our guest today is Jason Allegrante, who is Chief Legal and Compliance Officer at Fireblocks. Jason has worked at the Fed, Linkladders, and Davis Polk. Thank you so much for joining us, Jason, and gracing us with your wisdom.
Thank you for having me, Annelise, and thank you to Arca Labs for hosting us.
Thanks. So Fireblocks, aside from having one of the highest valuations in the space, offers secure digital asset infrastructure, allowing customers to custody assets, mint and burn tokens, and manage their treasury operations. So right now in the institutional space, I think one of the biggest issues is security, which really equates to institutional grade custody. So I'm super excited to talk to Jason today to understand a bit more about custody and where we're going and how we're solving that problem. So Jason, can you tell us a little bit about Fireblocks in your own words?
Yeah, that's great. I mean, Fireblocks is a security company first and foremost. Our co-founders are all ex-Israeli military intelligence. They are code breakers. They are cryptographers by background, and that's within the DNA of our company. And really, the company was founded in response to all of these institutional hacking situations. We saw a lot more of them kind of in earlier cycles, although unfortunately we still see too many today, right? But Fireblocks is the way to think about Fireblocks is that we are not a custodian, and what we mean by that is we are not an intermediary to your transactions. We're not an intermediary to the management or administration of assets belonging to the institution. We're a software company. Our software basically provides a suite of tools that enable our customers to custody and manage and administer their own assets. If you're building a digital asset business that's facing customers downstream, then you can hold those customer assets using the software. And then it's more than that as well. It's a platform or a network. So we securely connect institutions to other institutions, to trading venues, to OTC dealers, to DeFi protocols and staking protocols, if that's something the institution is interested in. But so that's what Fireblocks is. It's really a software tool that enables businesses to interact with the ecosystem the way they want.
So breaking it down a little bit, we have a few larger institutions that are creating their own custody solutions working with you. So you'll work with that institution and offer the additional layers of security for custody. Is that correct?
Yeah, that's right. So as far as our security features go, it's multi-layered and there's no single point of failure. And what's nice is they're not taking counterparty risks vis-a-vis Fireblocks. So first of all the assets are stored on chain. So they're all on the blockchain. The wallet is secured using what we call MPC technology. The way my lawyer brain understands this, right? It's basically generating a key that can then be broken into key shares with a controlling share given to the customer itself, and kind of what I just refer to as quorum key shares distributed into the cloud. And you're always going to need that customer key share to come to the table before the other key shares will come and unlock the value. So that encryption feature around the key, that's one major security feature. The second, I would say, is what we call our policy engine, right? So if you're an institution, you're going to have multiple people potentially interacting with the keys. They're going to be initiating transactions. As if you're the principal of the company, right? You're not always going to be monitoring the day-to-day on this, but you're going to be delegating downward. So what the policy engine enables you to do is you come in and you put a wrapper around the wallet that says, okay, so now an operator is trying to initiate a transaction that's greater than 10,000 in dollar equivalent value, that's going to get flagged. That's going to be immediately halted, and you're then going to need to get however many other members of the company as you designate to also approve that transaction. That's just a very simple example of how that would work, but it's basically an if-then policy engine that can create all sorts of permutations to meet the customer's needs.
Okay, so what about self-custody, concepts of self-custody and intermediated custody?
I think this is so important to understand, and I think it's actually worth going back to kind of the foundational principles of what it is we're talking about here. So the way I see it, and we've thought about it a lot, because custody is a kind of collateral management situation with a certain standard of care attached to it. What do I mean by that? The custody arrangement arises when there's property that belongs legally to an entity, but for whatever reason is in the possession of another entity. And then the entity taking possession of that property has historically, in a custodial relationship, offered in exchange a contractual promise to safekeep the asset. And like I said, that's a standard of care interpreted by courts in different ways. With physical assets, this has made a lot of sense over time, right? There's an intuitive understanding that cash kept under the bed isn't as safe as cash kept in the bank vault. And there are all sorts of operational reasons, again, going back in time as to why this might be the case. What's changed in the digital asset context, right, is we no longer have physical assets. We have assets that reside predominantly, in fact, entirely on the blockchain in the form of, digitized information. And how do you keep digitized information? We believe strongly at Fireblocks that having an intermediary, which is the old physical asset model, isn't necessarily the best way of securing an asset class. It's basically information. That's why we have a software product. The other thing that I don't think is appreciated in the difference between these models, or not fully appreciated, is what we're seeing in the digital asset space, because again, we're not talking about physical assets, we're talking about digital assets, internet native assets, blockchain native assets, is that your choice of custody provider or your choice of wallet provider for an institution actually becomes a kind of foundational decision that impacts the way you interact with the entire ecosystem. And what I mean by that is, if you take the digital assets and you work with a digital asset intermediary, that can be very good. And I think for cold storage in particular, this is often very effective. But if you go to a place like Fireblocks, where part of the package, the software package, is an ability to connect to other points within the digital asset ecosystem and to operate yourself a toolkit, right? So we have a tokenization engine. We right now have a complete payments product so that you can enable merchant payments and you can buy, you can receive in digital assets, right? And then at Fireblocks as well, we can connect the Fireblocks wallet to DeFi providers, staking providers, all these other points of interest that enable digital assets to, enable entities to execute strategies like treasury management strategies or investment strategies that you simply can't do either with an intermediary, or in most cases, because the intermediary is operating through a regulated entity that can't offer a lot of these services, at least yet.
So an intermediary being like a broker dealer.
Yeah, in the custody context, right? I think we're talking more about something that looks like a bank or a trust company. That's the predominant vehicle for custodying assets, I believe. And so a broker dealer is obviously an intermediary to a securities transaction, but even broker dealers, if they're holding customer assets, ultimately have to custody them at usually at a bank.
Well, now because they can't actually hold digital assets, but So what is if I were to buy shares of one of the private equity funds that have gone available that have been digitized, so they have to go with a qualified custodian. What is a qualified custodian?
A qualified custodian is a term of art that is that was included in the Investment Advisors Act of 1940. I say term of art because I think it's important for people to understand that it's a specifically defined term, and it's a term that has taken on a kind of a life of its own since that time. But it specifically means one of four things: a bank, a broker dealer, a futures commission merchant, or the foreign equivalent of any of those preceding three categories. Now, who needs a qualified custodian? Because again, this is a phrase that gets thrown out all the time. A registered investment advisor needs a qualified custodian. So that's a US SEC registered investment advisor. What's been really interesting, at least until this reproposal from the SEC or this notice of proposed rulemaking, is the amount of registered investment advisors, precisely for the reasons I was trying to describe earlier. When faced with the choice of using only a qualified custodian, that would be, again, one of the bank licensed custodians on the market. When looking at this rule and faced with the choice of only doing that or going with a custody stack that also includes Fireblocks, we have seen many of them also choose to include a technology provider like Fireblocks. And again, this goes to my point earlier, which is that you simply, at least today, cannot execute certain transactions. You can't execute certain yield strategies without having a service provider like Fireblocks, in this case, the stack.
So that would be, I put it with a qualified custodian, but I would hire Fireblocks as well because it would give me access to the different optionalities that you mentioned before.
Yeah, I analogize it, if I had to offer anything, to a kind of a bank sweep, right? So I have cash that sits in the broker dealer entity or the investment advisor entity at my bank, right? I see my bank account, my checking account, and then right next to it is my brokerage account, right? That also has cash in it, and that cash actually gets swept. It's available it's available to be deployed kind of during the day, but then overnight, right, it gets swept into the bank.
Okay. Kind of wrapping up custody before we go into a couple other questions I had for you. So why is the choice of custodian the most consequential decision for an institution that you feel?
Your wallet provider, and this is going to be true. What I'm about to say, I think, is going to be true for retail as well as for institutions. But your wallet provider or your custodian is the gateway to the digital asset ecosystem, right? So all for when it's your wallet or your wallet, all of your assets are coming in and out of that wallet. So it's a central hub to begin with. And then what you'll find is the service provider who is providing that wallet for you, whether it's an intermediary, whether it's Fireblocks, is going to be able to offer different services and different connectivities, right? And so we see this throughout the market. There are a number of worthy competitors to Fireblocks, but if you follow what I'm saying, there are advantages to choosing a service provider that can also be this point of connectivity, basically this hub to the ecosystem, as opposed to other service providers, which may be really, really great security products, but the assets end up locked in a cold storage solution or something similar like that, and they're not going to the places and doing the things that you might want them to do for you.
So there's a lot of asset managers that are hesitant to buy digital assets, and one of the reasons being custody. So what would you say to them that should they feel secure in buying digital assets today, and from a custody perspective, or expand on that a little bit?
Sure. I'm not sure if the concern is, well, let me put it this way. There are probably at least a few concerns, right? I think from a security perspective, there are a number of really reputable providers of custodial services on the market. The question is, do all those service providers give you an opportunity to do anything other than execute a buy, hold, long strategy, right? Today, Fireblocks enables a range of strategies, as I was describing. So I think there are two questions, right? From the security perspective, I think there are multiple service providers that are fit for purpose. I think there are legal and regulatory questions that should be asked by the RIAs and their advisors, right? And those are questions like, can we execute the strategy we're interested in using only a QC? Or is this something where we feel that it's possible to bring in a stack of service providers, right? But I think until all those things are resolved, right, I think it's understandable why RIAs would be hesitant, but I do think there are answers for these issues.
Okay, great. Thank you. I know you also spend time talking to regulators and legislators. Do you have any comments on kind of what about stablecoin? Are you hearing, like, what do you think about stablecoin and legislation in the US? That's a very broad sweeping statement, but.
So let's start with our take on stablecoin, and we'll maybe conclude with outlook for it. So we are extremely excited at the prospect of having stablecoin legislation in the United States. We see it both as a national security issue as well as a bottom line issue for institutional adoption. So on the national security front, the dollar has been the predominant fiat currency, since World War II. We'd like to see it maintain. We'd like to see the U.S. maintain its world leadership, right? And we think that the longer the U.S. delays in getting seriously involved, the more this actually becomes a pressing national security issue. On the commercial front, we basically see stablecoins as the currency of Web 3.0. So if you agree that we're going to be moving towards an internet of ownership or partial ownership, then that means we need an internet that's commercially enabled in terms of payments, right? To keep up with that innovation. And so stablecoins, right? Like you can't buy something on the internet with a $20 bill, but you can do it with stablecoins. And I think the retort to that is, well, can't you also do it with a credit card? But what we're seeing, I mean, the use cases we're seeing with our payments engine, for example, we're seeing stablecoin settlements that occur on the weekends. We're seeing seamless cross-border transactions. Obviously, stablecoins, by virtue of what they are, settle almost instantaneously, as opposed to a T plus 1 or 2 or whatever it is. And we have reason to believe that without an intermediary operating the payments rails, stablecoins will ultimately be much cheaper to deploy than other forms. So for that reason, we see stablecoins as a major infrastructure unlock for Web 3.0. We are very big on Web 3.0, and for that reason, we're also very big on stablecoins. In terms of the legislative outlook, just to finish that, there are champions on the House in particular for stablecoin legislation. This is actually something that's been brewing since the last Congress. We would love to see that bill introduced into this Congress as well. Obviously, I can't say pros and cons ultimately until we see the specifics of that. But we think having clarity around stablecoins is a good in and of itself, whether or not we agree or portions of the industry agree with the very specifics of how it might come out.
Carrying that a little further with the thought process of innovation in the U.S. and regulation, I know there's concerns of companies moving outside of the U.S. to help create and innovate. Do you have any comments on regulation internationally or U.S. based for encouraging innovation in the U.S. maybe?
So we started a user conference last year called Sparks, and we're going to do it again this year at the end of the year. But we held a roundtable at Sparks. The conference is for users of the Fireblocks platform, so there are customers already. We held a roundtable for banks just to talk about banking issues. We had 25 participants at the roundtable. 2 of them were U.S. financial institutions. 2 of them. And what we're seeing is the rest of the world really start to pull away in terms of the willingness to innovate, the willingness for the traditional financial sector to adopt and engage with this technology. We've helped an Australian bank tokenize its deposits. We've helped them issue things like tokenized carbon credits. And this is happening. This is happening right now in APAC, and this is happening right now in Europe. And as with all things in this space, right? Once it starts, once the adoption begins, right, it tends to accelerate very quickly. So from a regulatory perspective, like what's enabling this, we believe that clear rules and signals from the local regulator are absolutely critical. So if you look at what's happening in places like Europe, right? We already have MiCA in place, and we're just waiting to implement it fully. If you look at the UK now, they have a consultation for digital assets. We're talking to people in the UK who fully expect that by the end of the year they will have clear rules for the road, which I suspect will be a huge unlock, just as we're seeing elsewhere. And if you look at what's happening in the Middle East and APAC, you have the regulators in Dubai and Abu Dhabi who are very open to interacting with these assets. You have the MAS in Singapore, who's also taking a very open approach, and then you've just seen Hong Kong completely go in another direction than where it had been. It's going to be opening up its doors to digital assets. So from my perspective, the US is right now understandably in a reactive period post FTX. But we do see the rest of the world, moving ahead without them.
Great. Really appreciate all that. I have one last question for you, and it's really about Fireblocks. And I know that you're expanding. Obviously, you've started offering so many different services from your initial business line. And where are some exciting places that you're looking at now, like expanding business into?
Yeah, that's so I've already mentioned it, but we acquired a payments company last year. We've just come to market with what we call our payments engine. I think this area is so fascinating and so interesting. I think there's a lot of room for growth there. We're just talking quarterly results just among the management team over the last couple of days. We're seeing a lot of growth in Web3, which is exactly what we had hoped for. So I'm very excited. We're seeing a lot of names come into the building that are household names, and not at all the kind of crypto native trading shops that have really kind of been with us from the beginning. So I think this is a tremendously exciting area as well.
Fantastic. Well, Jason, thank you so much. I really appreciate it. If anyone has questions, they can go ahead and reach out to me, or I guess Jason. So I'm throwing you under the bus there.
No, absolutely. I'm Jason at fireblocks.com. Please reach out to me.
Thanks for your time, and we look forward to the next episode. Thanks, Jason.
Okay.